Happy Halloween, everybody. John King with Summit Funding, aka the Great Pumpkin today. Appreciate y'all joining me for my weekly market update. Lots of things to cover today, so let's rip off the Band-Aid and dive right in. We've seen mortgage rates have a pretty good week until they didn't. So this morning, the GDP results came out. Actually, I think it came out yesterday. They did come out yesterday. And this morning, the inflation report came out. Inflation is stronger across the world. Pretty much every economy in the world had stronger inflation numbers today. I think we're right at the peak of inflation right now, based on the data and statistics that I've been seeing. Inflation started going up significantly last year in October, and inflation isn't starting at a baseline. It's starting from what was it for the last 12 months. And so for the last 12 months, we've had high inflation. For inflation to continue growing at 10% per year, that means that prices have to go even 10% or 9% higher than they are now. Well, we saw a big spike starting in September of last year, and I think October of last year, we're going to see inflation kind of start leveling off, and that's going to be a good sign. But right now is kind of the worst of it, in my opinion. Doesn't mean it's gone, doesn't mean we aren't going to have any problems, but it also is about the bigger picture. And the bigger picture is we're heading towards a recession. Now, everybody said we're already in a recession, John, because we had the first 2 quarters of the year were negative gross domestic product. Now, I've explained multiple times about what GDP is. I'm not going to explain what GDP is, but I'm going to dive into it a little bit. The first quarter was negative for one reason and one reason only, because we imported a lot of goods. And GDP is how much stuff we produce in our country, but if we consume goods that are brought in, then that is a reduction of our GDP, because it means we're consuming goods we didn't produce. If we send out goods that we are not consuming, if we're a net exporter, then that's good for GDP and it goes up. So exports are good for our production, for our economy. Imports are not good for our economy because we're supporting somebody else's economy. So let me share with you let me point out first, the first quarter, everything was strong except imports. We imported a whole bunch. And why did we import so much in the first quarter? Because the fourth quarter, we had a bunch of shipping delays. We had ordered a whole bunch of stuff for Christmas. There were shipping delays in getting that stuff shipped in. So all the toys that were ordered by Amazon and everybody else for Christmas didn't actually get delivered until January. Didn't help us very much for Christmas. And it created a net significant increase because all of those imports were delayed from the fourth quarter that finally got delivered in January of this year. Now, the second quarter, we did have a loss in gross domestic product, but it still was similar reasons. So let's dive in now and look at the third quarter, and I'll compare the third to the second. And here's what we're looking at. We're looking at, this is the front page of the Wall Street Journal from this morning, and it says the economy grew in the third quarter, but warning signs flash. What was the biggest thing that contributed to the third quarter GDP? First of all, exports. We exported a lot of this in this quarter, so that was good. We weren't importing as much stuff, and we were exporting a whole bunch. So we were a net positive or net exporter. We exported more goods than we imported. Services are doing good, and then what's the problem is residential investment, which is mostly homes. Shocker, we all know that's the case. We all know that home values are a huge component of GDP. I told you guys in my fireside chat, if you didn't see my fireside chat, I got a link to it down below. I think that the Federal Reserve is specifically targeting the housing market to drive down inflation. And this proves that the housing market is being impacted the most. Housing and all related industries are down significantly. We're talking about being down 1.37%. Now, all the positives made up for the negatives. But the problem is that housing flashes a warning sign, and that's what they're talking about here. And let's look at what really contributed to the growth. And this is showing every quarter going all the way back to the fourth quarter of 2020. And it just shows you 3 categories. It shows you first of all, the bar is overall growth. So you saw in the first quarter it was negative because that bar was below 0. Second quarter was not as negative. Third quarter is back up. But what you notice is, where is it coming from? The beige is personal spending. The orange is net exports, and then the gray is other. Well, what we see is that, first of all, in the first quarter, we had a huge issue with net exports. That's now turned positive. But other was negative in the second quarter. But what we're seeing is personal spending is dropping. We're seeing less and less personal spending. Why does that matter? Because personal spending is a major problem in how we're acting, and we're acting scared. It's no surprise to you. We're acting scared because the economy is in a place where people are starting to get nervous. So were we in a recession for the last 6 months? No. It had to do with net exports and imports. But are we heading to a recession? Yeah, we absolutely are. And we're seeing a lot of volatility. So what am I going to say different this week? All I'm going to say is focus on outcomes. And I am finding myself, whether I'm talking with realtors or I'm talking to homeowners or potential homeowners, that everybody is so stuck in the moment. And being stuck in the moment causes you to miss the bigger picture. The bigger picture is, what are you trying to accomplish? And how can you use the circumstances today to take advantage of that? I know for me, I'm looking at this in a whole different way. My industry is falling apart. My industry is going to lose 50% of the mortgage companies and mortgage lenders in the next 6 months. What it is an opportunity for me to pick up new relationships. It's an opportunity for me to step in where somebody else has stepped out and to find opportunity. There may be fewer transactions, a lot fewer transactions per loan officer, but there's also going to be a lot fewer loan officers. And I'm committed to building relationships with people like you, my audience. Whether you're a consumer looking to buy, I want to be your lender. Whether you're a realtor who's looking to survive this market, I want to be by your side, helping to guide you, helping to give you personalized thoughts. So call me and let's set up a time. Let's set up a Zoom call. Let's talk about what's going on with your business and how I can provide my insights, what I've learned through coaching, what I've learned through dealing with running my branch and helping people across my company grow, and how I can help you grow your business. Let's focus on how we can capitalize on the challenges that we're dealing with today instead of shrinking back. Play big, be the biggest version of yourself you can, and take advantage of the opportunities in this market. Give me a call. Let's set up a time to talk, and I hope you have a wonderful weekend. Bye-bye.